Good afternoon, ladies and gentlemen. My name is Ryan Suter. I'm one of the senior investment managers here at Sharewise. And this afternoon we're here with Blair Turnbull. Now, Blair's the CEO of Tower. Blair's been kind enough to lend us his time and expertise regarding Tower, and he's just going to give us a brief presentation about Tower and how they're tracking over the past financial year. And then we're going to open the floor up, as per usual, to a Q&A. Now, if any individuals would like to submit questions for me to ask to Blair, please do so through using the Q&A section on Zoom, and I'll ask those. All right, Blair, thank you very much for your time, mate. It's all yours.
Thank you very much, Ryan, and thanks for the opportunity to update you on Tower. So we're going to now show this presentation, so just bear with me for 1 minute. Okay, just double checking, Ryan, you can see that?
You can see that very clearly. Thank you.
Well, look, thank you. And maybe if I can just spend the first few minutes just recapping the story of New Zealand insurance market. I'm not sure if too many of your investors are aware of New Zealand, but maybe if I just recap on New Zealand, and then I'm going to jump into Tower, walk you through a little bit of our strategy, how we're performing as a business. And at the end of it, I'd love to have some questions that we can banter back and forth on. But just a recap of where the market is in New Zealand. It's a great picture, this one. It's a reminder that, like Australia, we have a lot of homes, have a love affair with homes. And we also, as you can see from the picture, we're the second riskiest country in the world if you listen to Lloyd's. And that is because we have quite a few earthquakes, we have seismic, we have a lot of coastlines, and we get frequent storms. And I guess that comes together for two key points if you're in the insurance business. We love our homes, and we also really value insurance because we do understand the importance of protecting your home against the likes of earthquakes and storms and everyday general accidents, and also the same with motor vehicles and the like. New Zealand, it may surprise some people to know that actually we have the highest level of general insurance penetration of any developed country in the world. And that's something that, again, reflects our understanding of the importance of the home and cars, etc., but also the importance of insurance. If I just recap how big the insurance market is in New Zealand, the general insurance market, it's roughly about $10 billion Kiwi, which is just a little bit less than the Aussie dollar at the moment. And it's divided into two: personal lines and commercial. And personal lines, mums and dads, homes and motor vehicles, etc. That's roughly 5 billion. And Tower have 10% market share of the personal lines market. On the commercial side, that's big buildings, small businesses as well. We have a small share of the SME market, which we'd like to grow, but we don't play in the large end of town commercial businesses. So if I just recap Tower then, in terms of that setting, our strategy has never been clearer. We are 155 years young, but as we sit here today, we are very clear on our strategy. We are a direct insurer, personal lines, and small to medium-sized businesses. And that's quite different to a lot of traditional investors and traditional insurers who are a mix of commercial and personal lines, and also who are predominantly still with brokers and more traditional distribution channels like banks. So just to be clear, we are a direct insurer, and that's what differentiates us in the market. We invest heavily in technology, digital, and data, and particularly in personal lines and the SME market. And we distinguish ourselves around our customer experience, our operational efficiency, and also our geographic footprint, which is both New Zealand and 5 countries in the Pacific, which is Fiji, Tonga, Samoa, American Samoa, and the Cook Islands. In terms of that journey that we've been on to become the very best direct insurer down under, really, I'm going to skip through the first 145 years and focus on the last 10 in particular. Around 2015, we concluded that we wanted to invest heavily in their technology platform, and we rationalized our product set to align to that. So we took around 400 different product variations and product lines, reduced them down to 14. And that's because the key thing here is being a very streamlined, direct insurer. And I'll come back to this point because it's a real critical success factor for Tower. That sort of a chapter of investing in our technology, as mentioned, started around 2015, carrying through to 2020, where we also started to resolve some of the legacy issues that had been holding on to Tower, coming out of the Christchurch earthquake, EQC settlement in particular. Those legacy issues have now been resolved. Around 2022-23, we really focused particularly on digitizing the business as we came out of COVID. Increasingly, we saw that customers wanted to do things online. We do over 75% all of our new business is now online, and I'll talk to more of that shortly. We also started to really focus on streamlining our business as we drove for operational efficiencies. And part of that was buying old bank books that were closed from years gone by, buying those back and putting them into our direct model. And today, as I stand here, we have over 90% of our business is in the direct fashion now, and only a small part of it is linked to brokers. As we look forward, we're very clear. We want to be the best direct personal lines insurer down under. And that's at the heart of everything we want to do, is differentiating around our customer experience, investing in digital and data, first principles of risk-based pricing, which I'll talk to more shortly, being very streamlined, being very efficient in everything that we do. And we believe that is the success to a direct insurer. And here's a little bit just to sort of, as an example of how we sort of bring that to life. We have 150 years, as mentioned, in the Pacific and New Zealand. We have over 300,000 customers. Vast majority of that are direct and 10% personal lines. In terms of our premium, we're just under 600 million in premium, and we've been growing that at a CAGR of about 15% over the last 3 years. We are heavily invested in technology, as mentioned, and over half of all of our transactions are done and completed digitally. That's on the right-hand side there on the screen, and I'll talk to this a little bit more, is we really also differentiate ourselves around our approach to right risks and right price, and in particular, our first principles around risk-based pricing. And to help bring that to life a little bit more, what risk-based pricing is all about is understanding the individual perils that apply to your home or you as an insured asset. And so, you know, appreciating at the moment that we've seen quite a lot of weather events in recent years, both in Australia, but particularly in New Zealand. Last year, we had our biggest ever weather events. We are very sensitive to weather-related storms. And when we do pricing, we look at a household level. We use a lot of data, around 5 million pieces of data on our home policy portfolio. And you can see this little chart here on the left-hand side. It's a pictorial of all of those dots are homes, and each one of those homes we rate according to low, medium, high, or very high for flood, but also for seismic. And in the future, we actually will also automate it for slips and coastal inundation. And what you can see here on the right-hand side is the same visual of how we price during a recent flood in Auckland. And you can see where the water is pooled is where the orange and red dots are on the left, and where the green ones are is where we have the dry areas. And a big part of insurance, you know, running a really successful insurance business, is making sure you match the perceived risk with the price. That's really, really important, not just for the insurer, but also for customers. And if I just talk about that a little bit more, what we do know is, and as mentioned right up front, is that customers in New Zealand, in particular the Pacific, also Australia, really do appreciate and value insurance. But every piece of research all around the world really also highlights that 2/3 of people know they need insurance, but they don't really understand insurance. And when they look at their premium, they sort of say, well, why am I paying that much and my neighbour's paying something else? And so a big part of the way that Tower is actually presenting itself and managing customer experience is really being very transparent and explaining the insurance, making it very simple for customers to understand. And part of that was when you come and get a quote with us. In the past, you may get 50 or 60 questions about your house in order to take out a quote. And you can see here with Tower, through the use of digital and the use of data, we've reduced that question set to about 9 for new customers and even less as an existing customer because we know more about you. And when you also come and get a quote from Tower, what we will do is help you, like on this page on the screenshot of the mobile, is we'll help you understand your perils for your home and then how that relates to your premium. So we take that risk-based pricing and we help you understand if your home is low, medium, high, very high for earthquake, flood, landslips, and coastal inundation in the future. And all this comes back to helping people understand their insurance. And if they understand it, they'll then value it. And that creates a really good customer experience. One thing that we also understand in terms of, what differentiates Tower is that right now, many customers and communities are really struggling with affordability. And that's in response to, yes, inflation, record inflation, particularly in New Zealand over the last 12 to 18 months or so globally, but also we've been facing a situation of quite high levels of crime. And this, living crisis has put a strain on affordability for many customers. And the way that we're doing and responding to that is helping customers understand their insurance, helping them go online, and through excess options and cover options, they can change their insurance cover and help manage affordability. This is really, really important because the last thing that we want is customers to drop their insurance. They've got this beautiful home. We want to make sure that their insurance stays in play. And as mentioned right up front, New Zealand has one of the highest levels of insurance penetration of anywhere in the world. We're proud of that, and we want to make sure that that cover stays in place. So if customers are struggling at the moment, they know they can go on and see Tower, and they can adjust their cover and their premium to help manage affordability. And over the last year, this has really helped Tower produce some good results by making sure their retention of customers is stayed up very high. If I can now move, so that's a little bit of what I hope I've made clear there is Tower, how we are differentiated compared to a traditional insurer that still relies on brokers and traditional distribution through the likes of banks. Tower is very much a direct personal lines and SME player, and we lead out with customer experience, digital data, risk-based pricing, and that enables us to be a successful insurance business and always matching risk and price. Let's have a look at the numbers now as we turn to some of the numbers. In particular, if we have a look at the premium over the last few years, very pleased to say that we've had a consistent growth in premium. We're now just under, as of the end of March, we were 572 million on a 12-month rolling basis, so just under 600 million in premium. And that compares to around 350 million in FY19. So good growth, and we expect to see that growth continue as we look forward, and that's the guidance we've given to the market. In terms of their new business, it is predominantly online, and again, that's reflecting our approach to our quote to buy. The home and contents and products mix is well balanced between home and contents and motor. And we're very pleased with the retention of our book in the last year, despite some of those affordability challenges. We're very pleased with our retention levels, around about 77%. It's higher if you have home and contents with us in the high 80s. Motor's been a little bit under that as we have priced and reflected that increases in inflation and some of the crime that's come through. And through risk-based pricing, we have exited some lines of motor which has been higher propensity for crime. In terms of how we shape up as a business and how we focus, we are very focused on being a Tower direct business, and the chart there on the left-hand side highlights the growth in direct. Where we do partnerships is quite different. They are predominantly referral arrangements. We have leading partnerships with Trade Me Insurance, New Zealand's largest online retailer, and we also have referral arrangements in place with the likes of Kiwibank, New Zealand's only Kiwi-owned bank, TSB, and also New Zealand's largest mortgage broker advisory network, NZFSG. And those relationships are referral relationships. And in a way, they have no influence on the way that we do our product or our pricing. And we essentially pay for warm leads that come across to Tower, and we manage them as one portfolio under Tower Direct. As mentioned earlier, we do have a footprint in the Pacific, which we're particularly proud of. It's about 7% of our total premium. And at the heart of that, it's a big base offering in Fiji. Half of that premium is from our Fiji business, and the offering and the product range there is now very similar to NZ. And again, this comes back to the core success of any insurance business, is to have it very focused, very operationally efficient, and very streamlined. And so essentially we have the same Tower experience for all of our customers, whether that be in Auckland or Christchurch or in Fiji or in Tonga or Samoa. And that consistency of experience combined with the efficiency of all of our business being on one core scalable platform is starting to deliver the really good results that we're seeing for Tower. Talking to that point, management expense ratio, I'm sure the investors on the line here will appreciate the importance of this. Any business now has to be increasingly efficient and look for scale opportunities. The chart here on the right-hand side highlights Tower has gone from around 40% management expense ratio to where we are today, which is in the low 30s, and we've given guidance that we expect over the coming years to be in the mid to high 20s. And that reflects our focus on digitizing to create efficiencies, streamlining our business. So we did exit the Solomon Islands, Vanuatu, and Papua New Guinea in the last couple of years. And we also sold a small rural book so that we could focus our business around our core markets of personal lines and SME. We also have created an operational hub in Suva, which now handles over 50% of our calls. These are our staff, and they're on the same core platform that we have everywhere. And that gives us our ability to move workloads around the Tower group and really drive for efficiencies. All of that comes together to bring a management expense ratio down. If we roll our growth, the premium growth, and our efficiency and our focus on the likes of claims, right risk, right price, bring that together to show a picture of our underlying business performance. Very pleased you can see here that over the past years and looking forward, we expect a continued upward trajectory around our underlying net profit after tax and large events. And the yellow bars here are large events, and those can have an immediate impact on the year in terms of our reported profit and the like. But the key message of this is highlighting that over the last number of years and looking forward, we can see an upward trajectory of our underlying net profit after tax. We've managed to keep our claims ratio quite consistent around that 50% level, which is a good level for any insurance company, particularly for direct. And we've increased our allowance for large events from around about 10 million 3 years ago to now having it at 45 million. And if we look forward, we expect that allowance to continue further to around 50 million was our guidance for FY25 and 55 million for 26. So in terms of highlights, for the half year 24 highlights, which was what we shared with the market in May, We've continued to see good growth, targeted growth. We want the right risks for the right price, and that's why we adopt risk-based pricing. Anyone can write lots of insurance premium. Anyone can write $20 worth of insurance premium for $10. You want to write the right risks for the right price that can give you sustainable premium growth, and we're very focused on that. Efficiency, we've seen continued improvement in our expense ratio, now 31% at the half year, and that reflects the digitization work that we've put into the business, and also the operational efficiency through the likes of our Suva hub in Fiji. Our claims ratio, which crept up towards the middle of last year, reflecting inflation, supply chain challenges, and also heightened motor crime, is now normalized to around that 50% level, which we're much happier with. As shareholder returns, we were pleased to announce a 3-cent per share interim dividend, and certainly it's our intention, the board's intention, over the medium to longer term to have sustained earnings and dividend growth. This is the guidance that we updated as recently as last week. Underlying NPAT, we increased to 45 million or above. And we also earlier this year at our AGM shared an FY25 and FY26 target to give some confidence to the market over our medium to longer term aspirations. In terms of turning to FY25 priorities, they remain very consistent with what we have shared recently. That is targeted organic growth, right risks, right price. We continue to differentiate and invest in the customer experience, both online and across the phones, both for new business servicing and for claims. Continue to look for operational efficiencies, particularly through digitization, streamlining the business and process improvements. And we continue to invest in products that are both innovative and support future climate change resilience and sustainability. We have also addressing some of our past errors around MPD, which a number of insurers in the industry have faced into. We absolutely want to correct where we've made mistakes from the past. We have remediated to around about 60,000 customers, and we're working through the tail of that. That's a very high-level overview of Tower. Hopefully you feel a little bit more informed about us as a business, and I'd be delighted to take any questions that anyone may have. Back to you, Ryan.
Thank you very much, Blair. Really appreciate the presentation. We'll just open the floor up to questions now. I've got a couple that will kick us off with. We've got a couple flowing through from the Q&A function on Zoom, and then we'll ask those. Now, just to start us off, realistically, with Tower and how the insurance industry is travelling, what are the key trends that Tower is seeing in the market, and how are you guys positioned to capitalise on these trends, and or may there be opportunities?
And look, they're consistent, Ryan, with many businesses. They're all around the right growth, targeted growth that is sustainable. You want that business to come on. It's about operational efficiency. It's about streamlining the business, and it's creating solid, sustainable underlying earnings. And when particularly when I look at the targeted growth, I know as our business, a customer who has multiple risks with us. So let's say their home, their contents, and their motor, they stay on average with us for 8 years. A customer with motor only stays on average 2 to 3 years. A customer with multiple risks, we know more about them, we have more data on them, we can more accurately ascertain their risk profile and then have more targeted pricing. So it's not just growth for growth's sake, it really is targeted growth to build out really good relationships. Everything's always about operational efficiency, digitizing, streamlining the business, focusing the business, and making sure that we stay true to that strategy that will deliver ultimately good underlying performance.
Well, thank you for that clarification there. Now, obviously, Tower is particularly interesting in its position regarding your digital investment and your exposure. Do you think this is a large competitive advantage that Tower presents over the other insurance competitors in the market that may be larger and more consolidated players? Or is it just something that sets you apart and maybe opens you up to a younger marketplace that's newer to the insurance game?
Oh, look, I think it's really important to be true to your strategy. Our strategy does differentiate us. Whilst we may be 155 years young, we are really focused on being that leading direct personal lines and SME insurer. And that is differentiated from, I dare say, with total respect, to our larger Aussie insurers, which are more traditional insurers across Australia, New Zealand, other markets, more closely aligned to traditional insurers around brokers and bank relationships. We are very focused on direct. Why we think that's important is because we can manage and control the customer experience. We can control the right risks, the right price through risk-based pricing. We can really manage the efficiency of the business because we're not having to pay large trail commission fees. We can manage it more tightly, we believe, and we can be more agile. For example, if we can see inflation like we've seen in the last year coming through, we can respond very quickly to targeted rate changes, as we did. We did over 100 targeted rate changes in the past year to respond to that inflation, to respond to that crime, and to get the right price, the right risks and the right price. A more traditional insurer will have to go out and consult with brokers or bankers potentially, and that can take time, and then that can delay your response. So we do think, in terms of clarity around our strategy, being very agile, being very digitally data orientated, we do believe that's a differentiation for Tower and will ultimately set us up for good success.
All right, thank you for that one. Now, just on the topics of growth and being specifically consolidated in that market, does Tower see future levels of growth being more focused in the existing New Zealand market or other emerging markets focused with your Pacific presence?
We believe we've still got lots of opportunities in the New Zealand market and where we're targeted in the Pacific. For example, in Fiji, which is 1 million population, and we do think there's some good opportunities around direct motor and SME in particular. Similarly, in New Zealand, we've grown our market share of personal lines to 10%. We have a very small share of the SME market, that it's roughly half of the commercial market in New Zealand, so about 2.5 billion premium in New Zealand, the SME market. We have a small share of that at the moment, and we think there's a positive opportunity to disrupt that, like we've done in the personal line space. But we want to be very targeted with our growth. Again, anyone can grow general insurance. You can sell $20 worth of insurance for $10. You can grow lots of it. You want the right risk, the right price, manage that margin really tightly.
How competitive is the insurance space in the Pacific nations in which you guys are involved with in comparison to your standard competition levels in New Zealand and Australia?
Look, I think the market in New Zealand, like Australia, is very competitive. I think, again, it comes back to the very high level of general insurance penetration in both New Zealand and Australia. And I think customers here recognise they need insurance. They recognise we have weather events, and in the case of New Zealand, earthquakes. They know they need the insurance. And they're also, I think, very smart enough to know that they need to shop around and look for the right insurance cover. I don't always think that insurers have been transparent enough in helping customers understand their right cover. I think we're determined as Tower to really help customers understand their insurance and to enable them to adapt that according to their lifestyle, whether they've got, affordability challenges, they can manage that. So I think it is a competitive market. I think we're well positioned. In the Pacific, there are not as many competitors. In the Pacific, they're smaller markets, but we're very committed to those markets, and we're doing it because it's the same core platform and the same offering that we offer in New Zealand, and we have it on that same platform, and that gives us scale and efficiency, so we feel we can remain competitive in the Pacific and be targeted in where we grow.
Yeah, well, appreciate the update there. Now, that wraps all the questions up for me. We've got a couple here from participants, so we'll hand it over now. We've got one that states they're keen to hear how the Trade Me partnership is going, and how you might be using the TM data to drive down CAC?
Look, the Trade Me is a long-term relationship, a successful relationship that we've had now for about 7.5 years. So that partnership was started before I arrived, which was about 3.5 years ago. Trade Me is a very strong brand. It has around 2 million customers in New Zealand. They lead the way on both, obviously, customers trading everyday items. They're very strong on motor. They're actually also expanded into home through their homes.co.nz site now, and we partner with them right across their range of offerings. We really value that relationship. It's a very positive relationship. We have renewed that 2 years ago for a further 5 years, and I have every expectation we'll continue that relationship into the future.
All right, thank you for that update. We've got a participant that asked for an update on the strategic review that was initiated late last year, the purpose of the review, and is it still ongoing?
The review was announced by our chair towards the end of November last year, and it was a reflection that TWR, on a regular cycle, the board do a review of what's the best shareholding to support the business, and they undertook a strategic review to support, the transparency of that review. It had no predetermined outcome or no predetermined time, and at the ASM in February this year, and also the half year in May, the chair did say the review is ongoing, and if there's anything new to update, he will be the first to share it with the market.
Well, thank you for that one, Blair. Now, another one didn't ask, what provides the company the confidence to issue guidance indications for fiscal year 25 and fiscal year 26?
Sorry, can I repeat that? Can you repeat that, Ryan?
What provides the company the confidence to issue guidance indications for FY25 and FY26?
Oh, look, thank you. I think that the timing of that forward guidance worked well with the strategic review. I think you can see, I hope you can see, or investors can see on the webinar today, is that we have really streamlined, simplified, focused TWR, and we are very focused on the underlying performance and the drivers around growth and operational efficiency and how we've set this business up. And that has given us confidence to give a longer or medium-term out view of what the business can expect when we look forward, investors, what they can expect from TWR. It is the underlying performance of the business that gives us that confidence.
Thank you for that one. Now, just to pivot briefly here, if the 45 million before tax unexpected weather provision even isn't used in financial year 24, will the company look to distribute this as dividends?
We've been very clear that if the 45 million allowance or 32 million after tax is not used, it drops down into the underlying profit. At that time, the board and with input from management will then conclude what to do with those earnings. And we'll announce that once the financial year is finished. I don't want to jinx us. We've worked very hard to get into this position. At the moment, we're faced with a scenario that on average, New Zealand gets about just under 4 large events per year. Last year, of course, was the record weather events of the Auckland anniversary and Gabrielle cyclone events. This year, we are in the unusual position of not having recorded a large event. However, we will hold that large events allowance right up until the end of the financial year. And as mentioned, Ryan, at that point, the 45 million, if it's not used, 32 million after tax will drop into underlying earnings, and we'll update the investors in the market as to how that monies then goes back into the business or is distributed back to investors.
Thank you for that one. Now, how much of the FY25/26 premium growth forecast is attributed to price increases, and then obviously how much is attributed to customer growth?
Good question. If we look back over the last 3 years, it's roughly about 50% to targeted rate to reflect the likes of inflation or crime or risks or reinsurance, and 50% of it is weighted according to natural organic growth, welcoming new customers and building deeper relationships with existing customers. Over the past 12 months, that has looked more like 80% targeted rate, reflecting the record inflation, the higher cost of reinsurance, and about 20% organic growth. So it's been quite unusual in the last financial year. As we look forward, our expectation as part of that guidance is it will return to more like 50-50 again. So targeted rate, targeted organic growth. We do think there are opportunities to continue attracting new business to Tower, but always at the right risk, right price, as well as there will be some inflation still coming through the system. Although we have said at the ASM earlier this year that we expect the insurance premium increases to level off, and that will certainly be a relief, I know, for our customers and communities.
Well, thank you for that clarification there. We just have one on a minor different topic here. What are some criteria or some of the criteria for Tower to invest in products, i.e. mergers and acquisitions primarily in the startup space?
Yeah, look, 2 to 3 years ago, we went through and we did an M&A program to buy all of those back books. So they were books with banks that had long closed, and we decided to buy out those forward commission and bring them on into our direct portfolio. We also exited markets, for example, as mentioned, Vanuatu, Solomons, Papua New Guinea, the New Zealand rural, the small New Zealand rural book, to streamline our business. We know the business now is increasingly in really good shape. We will look at M&A opportunities where we believe they're value accretive and we can bring them onto our platform. The key thing that drags insurance companies down is complexity. We don't want to create new complexity. We've got a scalable platform. Where we see opportunities to potentially buy an insurance portfolio or a book line, we'll bring it on. For example, 2.5 years ago, we saw an opportunity to bring on a boat insurance book from Club Marine. We integrate that into our system. We built out really nice online boat quote to buy. We're the only one in the country to do that today. And there's 600,000 lifestyle boats out there, lots of jet skis post-COVID. And we've done very well and successfully in selling that boat insurance. So that's a really good example. If we saw an M&A opportunity to expand into our product set, brought it on, integrated it into our core business. We will continue to look for those opportunities, but only where we can see they're value accretive. We can do the operationals, we can support them with operational efficiency. They come onto our core platform, and we're certainly not short of ideas.
Well, thank you very much for the update there. We do have another more practically focused question here. How is Tower going about assessing motor vehicle crime claims?
This time last year, Ryan, we took some decisive action because we had seen motor crime heightened. And that was as a result of a number of models on various cars, and this has been quoted in the media, such as Toyota Aguas, which didn't have immobilizers and unfortunately were being stolen and used for likes of ram raids and other criminal activity. We took decisive action to rate against those models, and we have unfortunately exited a number of those customers because we just felt they were the risks associated with those models was too high. We're pleased to say that 2 things have happened. Certainly, our motor claims ratio has come back into line with our assumptions, which we're very pleased about, right risk, right price. But also we're pleased to say that the crime levels this time last year, thanks to a number of actions by police and government, have also reduced the overall crime trend. We're not complacent about it. We'll keep a very close eye to it. But at the moment, we're much happier with our BAU claims ratio for motor, which is now in the low 50s versus where it was this time last year, which was in the 60s.
We'll appreciate the update on that front. Bit of a different one here. What opportunities does generative AI present for your digital customer strategy?
Oh, I think all businesses now are very focused on AI. We have been leveraging AI for some time. For example, we have an AI fraud tool that we use and have used now for some time called FRIS, and it's a global tool, and that helps us to detect and manage fraud. And we certainly see lots of other similar and different opportunities around AI. You know, Tower as a business, we pay around 100,000 claims per annum. That's something that we're quite proud of. It's a big load of claims. And so obviously within that, for simplified claims, we do see opportunities to embrace AI to efficiently and effectively pay those claims. We also take over 1 million calls per annum to support customers, both in new business servicing and in claims. And again, we see opportunities around AI, and we have been piloting some of those to help enhance our operational efficiency of managing telephone calls.
All right, thank you for the update on that front. Now, just one last one that finishes off. An attendee asks, would buybacks ever be a consideration as opposed to a dividend? Tower spent 30 million a couple of years back on buybacks. As such, there is a precedent, although there has been a recent uptick in the share price.
I'll take that wrong. We are pleased with the share price, and at the end of the day, our focus is very much on driving the core underlying business, and we hope that the share price will take care of itself. Certainly, the board, as you would expect, are open and continue to explore all options, the most efficient and effective way to recognise shareholder value, and we will always be working with them to go through options as mentioned by that customer. And so obviously as we finish this financial year, we'll be talking more about and sharing as part of those full year 24 results, our dividend and dividend strategy and how that best presents for Tower.
Well, thank you for the clarification on that one. Well, Blair, that about wraps everything up. Before we finish things out, is there anything you'd like to leave us with?
No, look, just if I recap, I think the New Zealand market, again, has got the highest level of insurance penetration of any market in the world. Tower is a very well-recognised brand. We have over 96% brand awareness. Today, we've never been more focused in terms of who we are as a business and how we're differentiated as wanting to be the very best direct insurer down under, very focused on personal lines, very focused on risk-based pricing, how we present around digitization, operational efficiencies. And I think that's, sets us up very well in terms of looking forward to deliver ultimately sustained earnings and a very attractive dividend.
Well, thank you very much, Blair, for your time and your expertise. Thank you, Tower, for the opportunity to present with us. And ladies and gentlemen, thank you for your time. Enjoy the rest of your day. Cheers.
Thanks, Ryan.